I'm sorry, folks. There we go. I just quickly wanted to review some of the recently posted comment from last week's discussion. The bull put credit spread search, screening for high or increasing IV. We reviewed that with Steven and a couple other tools, and I'm going to review that in a way right off the bat. Short strangle discussion for Pierre, introduction and discussion. When we open a married put, do we consider the call premium as part of the reason for selecting a married put position, the potential call premiums? We took a current look at the market sentiment tool and what signals we saw in September. I believe we talked to Fernando about how to find lower risk spreads where the ratio is not 7-to-1 or 8-to-1, but closer maybe to a 3-to-1 or 2-to-1 risk reward ratio. We had a discussion on that. And then we talked a little bit about cash secured puts versus bull put credit spreads in a little bit. I believe we have another question related to covered calls and cash secured puts. Pierre's first question, his whole question is, in my trading account, I see that the margin requirement for options is somewhat 4 times higher than other online brokers. I've been looking around on other platforms and found that the margin calculation is very different from one place to another. Can you tell why? And according to your experience, what is the best platform in Montreal for trading options? Well, the first part of the answer is that there is no one standard for certain strategies. You know, for bull put credit spreads, they're most likely going to charge you the difference in the strike prices as a margin. But then there are some firms that use a subtly different equation for things such as short straddles and short strangles, which Pierre has asked about before. Some of them use a calculation of the short call strike price minus the call premium or plus the put premium and take a quarter or sometimes a third or half of that value of the total cash secured of essentially the naked call portion of the position. Others may require the full monetary requirement of selling the naked call and the naked put and the short strangle and the short put, or the full requirement of the strike price of the call that's sold minus the premium collected, but no ratio of a third or half of that total monetary requirement. On PowerOptions, Pierre had asked a question later on, back and forth via email. He said, what is the full requirement that's shown on PowerOptions Portfolio when you enter one of these positions? Okay, let's just quickly enter a short strangle. We're starting with a $100,000 account here. We're going to put in just a one contract short strangle on Berry Plastics because I know where the stock is trading. And this is not a recommendation or suggestion. We had our discussion on short strangles last week. And we talked about some of the risks involved with that position. So we're going to sell, in this case, an at or slightly out of the money call. And we're going to sell an at or out of the money put. Okay, so we're just going to use Berry. And let's just go 7 days out. The stock's trading at 60.35. So we're going to sell a 62.5 call for about 10 cents. And at the same time, we're going to sell 57.5 put. And let's give ourselves a little bit. We're going to put midpoint in here. So let's put in about 20 cents here. And let's put in 15 cents here, let's say. And again, we're just going to use one contract to keep the math simple. Okay, so here we have the position here. We see that our total monetary requirement shown in the PowerOptions portfolio for margin is 62.35. Where is this number coming from? It is the short call strike price, which is a naked call in this strategy, minus the 15-cent premium we took in for the call. We're not using any of that third or half of that or adding in the put premium in this case. It's looking at the margin requirement essentially for a naked call position fully secured. If I just sold a naked put position, I go in the portfolio and sell put by itself, short put, excuse me. And let's just take NVIDIA, for example. I think it's around 180. Oh, 208. Okay, and let's go 7 days out again. And so the stock at 208, let's just go to maybe 190. That's low premium, but let's go to the 195. Not a recommendation or suggestion. This is pretty close to at the money right now. But we're just going to do this as well. So we're selling 195 put. And now this went up to 25.73. So that's taking the full cash secured margin requirement, Pierre, of the 1 95 put on the position. That's a total cash secured put plus the margin we already saw in the requirement for the short strangle position and the naked call as well. Now, the one part I could not answer in this question for Pierre, I answered that question a little bit. The one thing that I can't answer for Pierre is the second part of the question there. What is the best platform for trading Montreal, Canada, and options for margin requirements on these type of trades, such as margin required short strangles and short straddles? I have no idea. I've never looked into that. I can't offer any advice. If anyone has any thoughts of a broker Pierre might want to consider looking into, just send it to us and we'll take a look at that as well. While we're here for David H, really quick question again. David says, I've been using PowerOptions to track stocks and covered calls. I've been adding the dividends to track the total return. However, I have misentered some of the dividend information. Is there a way to edit dividend information post-entry? I've looked and could not find a way other than enter a second entry to compensate, or third when I've really screwed up. Yes, there is a way. It is a little bit hidden, but I thought it was in the help video, David, but I'm not sure. So let's go ahead and get into a dividend paying position. I'm actually going to change portfolios here. I'm going to leave the October 8th. We're going to go to that radioactive trading portfolio. And I do still have a current position in Ally Financial. Originally bought stock at $47.95, lowered it a little bit. So the effective cost per share is $47.47. This isn't the actual trade in the Fusion portfolio. We've done other adjustments. So I think the cost basis on this position is down to 43, maybe a little bit lower. But first, how would I add a dividend? Very simple. We use the More Information button. We go to Position Actions. We simply click on Add Dividend. Now we can enter it as a total cash amount. If I wanted to put in, I got $18 on a dividend and I had 200 shares, I could put in $36. Or I could put a per share amount. So let's go ahead and just put in 18 cents, very simple, for a dividend per share amount on 100 shares. And let's say we got it today. Oh, whoops. Of course, I did that on purpose. Now the effective cost per share is at $29.47. I did not mean to enter $18. I meant to enter 18 cents. How we can go about doing this now is if we go into the notes field, the events and notes field, clicking the book icon next to your positions, David, you see all of the entries that are here. And you could just delete the event directly from here and re-add it. That's one way to go. The easiest and simplest way to go is, what do we have here? What is Ally Financial? Well, it's a position where I entered the stock and I entered my put and I entered the prices. But if I made a mistake in entering the original position, I would have gone to Position Actions again and Edit Position. And here we have the same value. So I can edit this right here. So this would only have been $18 per 100 shares. Or I could just straight away delete it. Now, the effective cost per share has dropped from $47.47 down to $47.29. So just like you would edit a position, you can delete the portfolios through the events and notes. Delete the dividends through the events and notes. Or use the Position Actions menu, edit position, and any dividends you received, you'll see right here, David, just change that amount to what you need and resubmit it, and you'll be back to square one where you needed to be. David says, I'm a new subscriber to PowerOptions. Welcome, David. I hope you're enjoying it. And I'm trying to find out the features. I set up my portfolios the following. Starting basis, $23,500, cash on hand, $15,000. My question is, if I want to add some money on my account, for example, $20,000, where do I add this amount? On starting basis or on cash on hand? The answer, David, is both. Okay, here's why. We're going to create a new portfolio. We're going to call it David. And I'm sorry, you said 15,000 cash on hand and a starting basis. Okay, so I'm sorry. My cash on hand I enter first and the starting basis at $23.50. Now, Yeah, date doesn't matter in this case. In the help video section on this page, it'll walk you through most of this, but in the help videos, what I discuss is that if I'm trying to create my portfolio from scratch, I have a portfolio that exists, I already have positions open in it, stocks, spreads, diagonal calendar spreads, maybe some other married puts, of course. And the total portfolio value is $52,000, okay? What I'm going to do is put in the starting basis and cash on hand. I'm going to put in the cash on hand of $52,000 and copy that over into the starting basis. Because now, once I create this portfolio, David, and I start adding in my positions, it's going to start subtracting out from the cost basis, the starting basis, the cash that I've allocated to those positions. So it'll end up with where I want after I put in the $8,500 I have allocated to one or two positions in this case, but I'd start with the same. But that's perfectly fine. You already probably did that, and you've got it accounted for. That's just to help others. Now let's go to our portfolio. I started this portfolio here. I have some position somewhere that has $8,500 allocated to it. Here's where we currently stand. I get a $10,000 lottery ticket. Who knows? I'm going to put it into this account. Okay, so how do I do that? Well, if you just click on cash on hand or starting basis or go back into setup, you can make these adjustments. Now, what happens if I just add $10,000 to this position and put my cash on hand at $25,000 from $15,000? If I save those changes and go back to the portfolios, this is going to appear that I'm showing a profit on the position right now, the profit on the total portfolio. Yes, we're not accounting for the position where the $8,500 was, but this would appear as an inflated profit in your portfolio for the influx of the cash amount. What Ernie and I suggest is that if you're adding $10,000 into an account here, or even $5,000 into your account, you add it to both the cash on hand and to the starting basis. And the reason why is because now you're still getting more of an accurate depiction of the total portfolio profit and loss, your options transactions and stock transactions profit and loss, because you moved both. Oh, shoot. Well, let's edit that. Good job, Mike. So that's the other alternative. If you just add it to the starting basis and not to the cash on hand, you're going to see a very bad return on your portfolio because it's not reflecting the cash on hand. But see here now, we've increased both by the $10,000 roughly. You know, it's supposed to be $23,500, but we increased both by the $10,000. The loss that's showing here is because I'm not accounting for that $8,500 I have in the other position. So to make sure that your portfolio return is still accurate, is still reflected close to what your options return is, when you add cash, add it to both the starting basis and the cash on hand.